I'm Mia Johnson. I'm your instructor for today. I am a licensed Texas real estate broker and realtor. I became licensed in 1994. I started teaching in 2011 with business courses, and then I decided that I would start teaching real estate courses in 2019. Today, I want to talk to you about securing a real estate loan. Many real estate purchases are financed. I will discuss methods used to secure real estate loans. You will need a basic calculator for this exercise. Our objectives are to identify components of a monthly mortgage payment, identify underwriting standards, and also calculate the monthly mortgage payments and qualifying ratios. So what are mortgage payments? We use the acronym PITI to describe the components of a mortgage payment comprised of principal, interest, insurance, and taxes. Loans with less than a 20% down payment will include mortgage insurance. It may also include homeowners association fees. The acronym PITI is defined where principal is the amount you borrowed to pay back. Interest is the amount you pay for the rent of the money. Taxes are paid to your local government as ad valorem taxes. Insurance is your hazard or what we call homeowners coverage and or flood insurance for that property. So now that we know what's included in the monthly mortgage payment, what are the standard mortgage guidelines? What we see in practice is lenders may offer slightly different loan products and debt income limits. Borrowers meet mortgage underwriting guidelines based on their income, their debts, and of course the loan type. The percentage of gross monthly income allowed for housing expenses that includes association dues is called the front end ratio. The percentage of gross monthly income allowed for housing and all total debts is called the back end ratio. When you look at this chart, for a conventional loan, the gross percentage allowed for housing is 28%. The back end ratio, which includes all expenses, is 36%. For an FHA loan, the front end ratio is 31%, whereas the back end ratio is 43%. And then for a VA loan, your Veterans Administration loan, we don't have a front end ratio. However, we do have a 41% back end ratio. So, how do we qualify borrowers? Let's calculate the monthly payment. We'll start with the payment and interest, the P and I. $133,000 divided by $1,000 multiplied times 7.34 equals $976.22. For the private mortgage insurance, which will be required in this case, since we are paying less than 20% down, we will use the loan amount of the first mortgage at $133,000. We'll multiply that times 0.75%, which equals $997.50. We'll then divide that by 12 so that we will know our monthly payment of $83.13. Our monthly taxes need to be calculated. Annually, taxes are $2,640 per year. We will divide that by 12, which equals $220. Insurance is $360. We will divide it by 12 as well, which is $30 per month. When we add all of these numbers together, $976.22, $83.13, $222, $30. Our total monthly payment is $1,309.35. Now let's look at Fannie Mae qualifying income and debt ratios. The gross monthly income, we will combine their gross monthly income and divide it by 12 so that we can determine their monthly income, which is $5,125 combined. Next, we'll take a look at their maximum house payment. We will look at $1,025, multiply that by 28%, which is their housing ratio for this type of loan, which equals $1,435. In terms of the maximum total debt payments, we will look at their gross monthly income we'll multiply that times 36%, which is the back end ratio for debts, and the result is $1,845. When we examine the front end ratio, we see that when we look at the monthly payment that's required for this particular loan is $1,309.35 divided by their gross monthly income. We see that it does qualify in terms of the front end ratio because 26% is less than 28%. When we look at their total expenses, which includes the housing expense and all of their debts, we see that it comes to $2,130.35, meaning the back end ratio does not qualify because it comes in at 42%, which does not qualify. It's more than 36%. We know this by looking at their monthly payment that's required, their total debts. We divide that by their gross monthly income, which results in 42%. So the conclusion here is that their debt ratio is too high. In this case, for the Fannie Mae, 28%, 36% qualifying ratios. So what options can we offer the borrowers in this case? There are standard guidelines that are used for loans, although lenders have their own practices because they're offering various products to borrowers. So the debt to income limits for borrowers can vary. Viable solutions for this particular practice exercise might consist of paying down debts, like the car loan, because by paying down the car loan, then that will decrease the amount of money that's owed for the debts. They could also look at a contribution from the seller in terms of perhaps their closing costs for assistance. And then the other thing is, this particular couple could look at a qualifying FHA loan. Now that we have walked through this exercise, we can pull everything together. We can define components of a monthly mortgage payment. We can describe typical mortgage underwriting standards. And we can also calculate standard Fannie Mae debt to income qualifying ratios.